What if owning a government bond, a house, or even private investments became as easy as sending a text message? This is not science fiction anymore. It's called asset tokenization, and right now, banks, regulators, and governments are quietly rebuilding the financial system around it. In today's video, we will break it down for you in simple terms. So let's dive in. So here comes the first question. What is tokenization? At its core, tokenization means turning the ownership rights of a real-world asset into a digital token on a blockchain. The asset can be real estate, bonds, commodities, or funds. Yes, that is why we call it RWA, Real World Asset. These tokens represent who owns it, what rights it gives, and how it can move. Digital. Tokenization is not about scanning paper or putting PDFs online. It's a deeper shift from slow, account-based systems to programmable assets that can move, split, settle, and even earn automatically. Importantly, not all tokens are the same. It comes in multiple forms. Today, we already have stablecoins which represent money itself. But now, we are also seeing tokenized bonds, government treasuries, private credit, and even tokenized real estate. Means we have different types of real-world assets, but they all are having the same digital logic. According to Deutsche Bank, over 90% of the tokenized asset market today is still dominated by stablecoins, but that is rapidly changing. For years, tokenization stayed small, but suddenly things changed. The market for tokenized assets has grown thousands of percent in just a few years. Stablecoins still dominate, but tokenized government bonds and private credit are now growing even faster. The biggest reason tokenization failed before wasn't technology, it was regulation. That's not changing. Countries like the UK and Singapore are saying something important. If an asset looks like a security, it will be regulated like one, even if it's digital. Global policy groups warn us clearly. Tokenization failed earlier because there was no liquidity, no shared standards, and too much legal uncertainty. Technology alone was not enough. What's different today is infrastructure. Compliance, identity checks, transfer rules, and audit trails are being built into the system itself. That's what institutions need to trust digital assets. But here's the key insight. Tokenization works only when compliance, settlement, custody, and identity are built into the system, not added later. This is why platforms like the XRP Ledger, with its multi-purpose token MPT standard, are gaining institutional attention. Ripple's report explains how embedding compliance, metadata, transfer controls, and auditability directly at the protocol level removes friction and reduces risk. Institutions don't want experimental finance. They want predictable, auditable, regulated infrastructure. When banks, regulators, and policymakers all agree, it's worth paying attention. Tokenization is not a crypto trend. It's a capital markets upgrade. So the real question for 2026 is simple. Essentially, it is not about will these assets be tokenized, but about who builds trust, scale, and provide real liquidity first. This time, the foundations are finally in place. In short, tokenization is no longer about experimenting with technology. In fact, it's about redesigning ownership for a digital-first financial world. I will end this video here, and if you like this video, don't forget to like and subscribe our channel. I will see you in the next video. Until take care and bye-bye.